Welcome to Life Planning 101, brought to you by Smart Money Group and Kennedy Financial Services in Eastland, Texas. Tune in every week as we share important information to help you and your family live life on purpose. Insurance, investments, legacy and tax planning, and much more. All covered now on Life Planning 101.
Welcome into Life Planning 101. My name is Angela Robinson with Smart Money Group and Kennedy Financial Services out of the big town of Eastland, Texas, and Three Forks, Montana. I gotta get used to saying both locations. It's surreal, folks. Anywho, let's talk about pocketbook savings. After all, we are living in a little bit of a, I don't know what you call expensive environment to live in. And how can you find some room in your wallet? And no, I'm not talking about Capital One. Ha ha. No, this reminds me, one of my dad's favorite jokes. If you've been around my dad for 5 minutes, I guarantee you've heard this joke. I can't tell you how many times I've heard it. And it's really not a joke. It was a true story. He talks about one anniversary that he and my mom went to the grocery store because they both forgot to get a card for each other. And so they just picked out a card together, each handed each other the card, read it right there in the store, and put it right back on the shelf. Well, I'd say that's finding a little bit of money in your wallet. That's one way a financial advisor does things to keep frugal, right? But in truth, those cards really are very expensive. I notice if I go in and I've been last minute to get a card and some tissue paper and a gift bag, oh my goodness, it's more expensive than the gift is usually itself. It's crazy. But let's just face it, life is expensive today. It was only, you think about this, only a few years ago, I'll never forget Aaron doing a podcast and talking about what pre-inflation feels like when, man, everything feels so good. You finally got all the excess paid off. The credit cards are paid down. Life is good and there's excess in your pocket. And then bam, all of a sudden it's not longer excess and it's tight. And then bam, now it's tight, but then I wasn't able to pay this and this is accumulating and et cetera, et cetera. And it was really only a few years ago this all started to happen. We do remember COVID quite well. I don't think that's a memory that we will forget. And that's really the genesis of what we've experienced over the last few years when money just kept flooding the economy with all the stimulus and then more stimulus and then more stimulus. And we got to meet our friend inflation, the thing that people didn't even think existed anymore because we hadn't even seen it since the 80s. But we certainly see it. We certainly feel it. It is expensive to live today. And, I think inflation is really kind of like a beast. It just eats your money and eats more of your money. And you can't change a lot about it because, we used to tell the story when we were doing retirement workshops that, say you retire and you go to the grocery store and you got in your budget $100 to go to the grocery store each and every week. How many bags of groceries is that $100 going to buy you? Well, today it might be a couple. But what if those groceries over time now cost you $200? If you haven't planned well for that inflation, then what are you going to put back on the shelf? Well, if you're already at 2 bags and you got to drop down to 1, that might get a little iffy, right? But that's what inflation is. It is a money-eating beast that a lot of times you can't change the circumstance of it. It's out of your control. But here's the thing. You can find ways to pad your pocketbook a little bit more. You just got to look strategically and tactically. And really, you should probably do this once a year anyway. And I didn't even go through, I think it was a few years ago. In fact, Chris, I know you're listening in to our podcast. And shout out to Chris, by the way. I just want you to know this guy, we call him Chris Rock. And the reason we call him Chris Rock is because he is a rock star. Each and every week, he works to get weekly life lessons out. He helps with the Black and White Market Chatter. He helps with Life Planning 101. And make sure that we're always putting out relevant content to help you live life on purpose, to empower your decision making. And he's always coming up with great ideas, keeps our website current, just very thankful to everything he does. It helps with a lot of our client communications. in bulk, and any kind of strategies that we're doing that throughout the year that we need to create some type of material to show you. He's involved in a lot of that. So just forever grateful for all he does in the firm. So here's one more thing to add to your list, Chris. I know we did a few years ago, we did something on, cleaning up yours. I think it was like spring cleaning or something. And we talked about cleaning up like all your app costs and this and that. We need to find that. Put this with this podcast, with this weekly life lessons, because I do think, people are looking for every single way that they can be saving money. And you need to be doing that once a year, whether or not we feel like 2020 and our pocketbooks are padded, or we feel like 2025 and we're thinking, oh man, do I really need to eat out again this year? Because it's just gotten so bad. So yes, so there are a lot of spring cleaning things you can look at. We'll put that out there. But today I want to talk tactic. I want to talk about some things that I'm seeing over and over again. And we've got a list of ideas here, about 5 of them, to get you started, to jumpstart you, so to speak. So let's dig in. Number 1. Lower the cost of your home and or auto insurance a couple of ways. Now, this doesn't mean that you're going to be able to, but you definitely need to be looking at it, and as is all these series. So insurance, the cost of insurance has gone up crazy over the last few years. Inflation has been a big kicker in that, but also, have you noticed the amount of natural disasters that have been happening? Well, these insurance companies are taking quite a hit. And there's another little unknown fact to this. You carry insurance for a reason, which should be to hedge a risk of loss in a catastrophic event. Well, unfortunately, we've kind of lost sight of that reason, and we have become a society that believes our insurance is there to pay for every little fender bender, cracked windshield, plumbing issue, or whatever small repair you may have. Don't even get me started on the health insurance side with this. Oh, by the way, that's a bonus. Yes, if you're in good health, you might want to look at some type of sharing program like MediShare, Samaritan's Purse, things like that in relation to traditional health care, because those things oftentimes are just for these catastrophic events, which I'm going to get into here in a minute. But that's a bonus. I didn't even think about that one for today. So if you're listening versus reading, you just got a 1-up. But in fact, Chris, why don't we put that on the newsletter as well this week as introduction to MediShare and how that may be able to be a solution to lower your healthcare cost. But the problem with this thinking of that you need to pay for every little thing with insurance, because this is the same thing with healthcare, is what has happened to the healthcare insurance premiums over your lifetime. I know you're laughing, right? Yes, they have gone up like horrendously. Well, that's because healthcare used to be just for those catastrophic events, and now it's for every little thing. Well, that's the same thing that we're seeing in the property and casualty field. The problem with that type of thinking is that you got to realize is that insurance companies are quote unquote for-profit companies. And so guess who's going to ultimately pay for all those little bitty claims? Well, that's you, of course. So the good news, there is good news, there is silver lining in this, is that you can opt out of this thinking in a sense, and you can benefit from your choice financially. So here's my consideration to you. Are you good about carrying your emergency funds and having the right amount in place? And if you are, you might want to think about carrying higher deductibles. That may make sense, because sometimes when you raise your deductible, the difference between what your deductible is now and what your deductible you're raising it to, you might be able to pay that cost difference between 6 months of premium, a year of premium, right? So then you're actually putting more in your pocketbook, even if you do have a claim, and much more. You really don't want to file for all those little fender benders, cracked windshields, and all those other things. These companies are quick to drop these days. Quick. I've heard more people getting dropped from their insurance, and it's because of the overclaims. So if you're willing to do that, your premiums should go down, and sometimes very significantly. So ask, what can I do for a deductible on this? And a lot of times on auto insurance, I also see this is you got comprehensive coverage on a vehicle that's 20 years old. Is that really what you need? If that vehicle stopped working, do you really want to be paying the amount you're paying for that comprehensive coverage, or should you just go to liability only? That might also be something you want to consider. So your premiums should go down if you look at those costs and, just treat it like we used to treat insurance. Think of it as a catastrophic measure. Make sure that your emergency funds are in place, et cetera, et cetera. Another little bonus to this is you hear the commercials, consider bundling your home, auto, and umbrella liability insurance. Maybe they don't say umbrella, but I would, because majority of our families that we serve need an umbrella liability policy. You know that if you've met with us. So, consider bundling all that with at least one carrier or one agent. So not only can that provide cost savings, but there's another bonus to that consideration. If you keep your insurance with one agent, there's less chances there's going to be gaps and overlaps between the policies, creating excess costs, but also excess exposure to unwanted liabilities. And at least, it kind of puts that back on your agent to make sure they're doing a good job, because they may be liable if they miss something in that. For example, a lot of people don't realize that your umbrella policy requires you to carry specific underlying liability limits in your home and auto policy and your other policies. And if those policies aren't carrying those underlying liability limits, then that umbrella policy may not pay. That's what you heard. It's exactly right. So I am not a property and casualty agent, but I have seen enough property and casualty insurance in my lifetime to know you need to ask a lot of questions and make sure what you have is what you really have. So there's your bonus for today. Well, I say today, I might give you a few more. Let's get on to number 2. My gosh, we're 10 minutes in. I only gave you one. So number 2 pocketbook savings idea is rack up some points. Why don't you? I mean, if you're going to spend money, you might as well spend it responsibly, getting credit card points. A lot of times people say, well, I don't pay anything on a credit card. I don't want to do that. Well, credit cards are not your enemy if you use them responsibly. In fact, they can be your best friend to your pocketbook when it comes to home improvements, repair, travels, or even cash. Think about all those things. I sound like a commercial. Good Lord. Anywho, so if you're not taking advantage or accumulating points that could help you pay for these other things that you are going to need or want anyway, you're really missing the boat. And I think the website is Card Gurus. I think that's what it used to be. But there's a great website out there that helps you say, which is the best credit card for me? You can even just look that up. You can just say, which is the best credit card for me? And I'm sure that is going to pop up for you and give you the answer. But it's a great resource to help you find what makes sense to keep in your wallet, not just because Capital One says this is what should be in your wallet. And a bonus to that is maintaining lines of credit like credit cards is really, really good for your credit score. You need 3 to 5 majors like Visa, MasterCard, American Express, not shop cards, not JCPenney. That's still a thing. Anyway, I always remember my mom as a kid, JCPenney card. But you need those 3 to 5 cards, and that helps you keep a great credit score, because a little known fact to your credit is if you don't use it, you begin to lose it. And that becomes a real challenge specifically for retirees, people that have paid off their mortgage, widows, widowers. This becomes a challenge, and you need to think about how you can use credit where it makes sense. In fact, installment notes are another good thing to make sure you do ever so often, whether it be 0% on a mattress or 0% on a car. 0% on a car sounds great these days. Anywho, I digress. The point is, there is a bonus to that. Let's get on to number 3. Pocketbook savings. Earn something. Why don't you? Anything. Okay. It is astonishing to me. In fact, it's almost like downright criminal. I don't think they should be able to get away with this. Is that banks and credit unions, a lot of banks and credit unions, not all, but a lot, are still paying very little to no interest on savings accounts. And that really just seems downright criminal. I don't think they should be able to do that when, we can literally go out there and shop short-term money, whether it be treasuries, money markets, yields, whatever those things are, that are paying 3 to 4.5% on any given day, maybe higher, especially in the past. And so just imagine that you had $100,000 sitting in a bank last year earning 0.25% when you could have earned 4.5. That means that you lost $4,250. $4,250. That's crazy. So don't let your dollars lose dollars 1 second longer. You need to get paid when you have cash. And you should have cash, by the way, because you should have an emergency fund. So there's no reason you shouldn't have money that's earning something. And if you're not earning something, you need to be earning something. So there's number 3. Now, number 4, similarly but different, slash your interest payments. And I'm going to give you a couple ways that you can look to do this. So interest payments, meaning if you owe money to something, what are you paying interest rate wise? So interest rates are moving, and I'm not going to say that they're coming straight down by any means. In fact, everybody thought when the Fed lowered things a quarter of a point that just make everything lower. Well, that's really not the case because for example, the 10-year constant moving treasury went up after that. It actually went up, not down. And different banks, and this actually started happening, I don't know, it wasn't that long ago, less than a decade ago. I sometimes lose track of time. But different banks benchmark to different things. They're not all benchmarked to the Fed's rates or to prime rate. I mean, a lot of people hear prime rate or the London International Bank rate, as it was called. They're not all benchmarked to the exact same thing. So, and the other thing to note is that banks specialize in different areas. One bank may specialize in auto loans, where another bank specializes in real estate, where another bank specializes in business. They have, their boards pick this allocation of assets that they want to have on their books, and that's what they try to tailor to. So it's important to shop things around and not always just take what the bank that you've always been with and always used is the best thing that's out there. Because like if yours uses different rates, and I remember looking at something for a client a couple years ago for a mortgage, and we were looking at anywhere from 5% to over 7% for the same mortgage in different banks. So you need to be shopping around and you need to be watching what's going on there. A general rule of thumb is that you don't want to refinance something unless you can get 1 full point. Now, that's a general rule of thumb, and that's usually based on real estate. So other installment notes or things like that could look a little bit different. But even if you can't refinance today, you need to get to know what's out there and be watching for that index or those indexes and what they look like, and be prepared to pull a trigger because rates could slide down a little further and it could give you some opportunity. Another thing to note is 0% does still exist. It does. So credit card in debt in this country is out of control. It's enormous. And if you have it, you're probably getting this queasy feeling every time that you open that statement and you have that interest to pay. So if you do, stop right now and you need to strategize. Number 1, how much extra can you put towards all your debt, or are you already doing, most likely? Number 2, what is the quickest way you could pay your debt with the excess payment? We're here to help with that, by the way, but you need to be able to strategize that because sometimes it's paying the highest interest early. Sometimes it's paying the one with the least amount of balance to get it paid off so you can pay it towards the highest interest. There's different ways to look at that, but you need to strategize that. Number 3, do you get any credit card offers for 0% interest or low interest? Because I know that sounds crazy, but you could crunch down during a promotion period and pay a big chunk of your debt at a much lower interest rate because there's only like a 3% introductory fee versus your 17% interest or 20% interest. So you really need to focus in on interest, and it will help your pocketbook. Now, number 5, tax take back 2026. It's right around the corner. Can you believe that? Right around the corner. And there's a few new tax breaks that you may be able to be eligible for. Tips, overtime, being over 65 years old. Car purchases, yes. So now is the time to know how this is going to affect you. Why? Why now? Why not when something happens? Well, what if you could reduce your withholding or tax payments and keep dollars working for you just because your taxes are, they're going to be lower? Wouldn't that be great? I mean, going back to what cash is earning these days, even if you're not going to spend it, just to sit on it and earn something is better than giving it to the IRS for free, right? Yep. So I think that's the only thing worse, by the way, than a bank paying you very little is giving Uncle Sam a tax-free loan. Just the sound of it. Ugh. So imagine you overpaid your taxes in 2026 by $10,000. That tax money is money you might not see again until April of 2027. Or worse, if you file an extension in October of 2027. So you could literally look at 22 months of zero compounding interest that you have missed. Oops. Exactly. So a bonus here is take a pulse on your retirement while you're doing this simultaneously. This is one of the best times in history to be checking in on your financial plan and your tax plan simultaneously. Find the money from Uncle Sam to help you take care of your future. Face it, taking care of your future is not always easy and it's not always the top of mind, but you know you need to be doing it. So why not do it when you're looking at your tax planning? Now, I say all this, right? We've got a lot we covered in a short period of time. Obviously, this is going to be in our weekly life lessons. Be sure to sign up at www.kennedy-financial.com. But talk is cheap, my friends. Taking action is what matters, especially on things like this. So I recently met with someone that we ran an analysis last year to reduce their liabilities by 7 figures. And that sounds amazing, right? And we went through kind of that tax plan we talked, or that liability plan we just talked about. But they didn't even do anything with it. It just sat on it for 12 months. Sat on the shelf. So I now ask you, what do you think that cost? Yeah, do you want me to be telling the same story about you? I don't think so. So take action today. Pad your wallet. My name is Angela Robinson with Smart Money Group and Kennedy Financial Services. God bless you. Have a wonderful week, and be sure to join us right here next week on Life Planning 101.
Thank you for joining us for Life Planning 101, brought to you by Smart Money Group and Kennedy Financial Services. If you have questions, you can email them to lifeplanning@kennedy-financial.com. Don't forget to learn how our sister company can assist you with all of your tax and consulting needs. You can find out more at briscoeandassociates.com. Be sure to tune in next week for more Life Planning 101. The opinions expressed herein are those of the firm and are subject to change without notice. The opinions referenced are as of the date of publication and are subject to change due to changes in the market or economic conditions and may not necessarily come to pass. Any opinions, projections, or forward-looking statements expressed herein are solely those of the author, may differ from the views or opinions expressed by other areas of the firm, and are only for general informational purposes as of the date indicated. Securities offered through Calton & Associates Incorporated, a registered investment advisor, member FINRA SIPC. Investment advisory services offered through Smart Money Group LLC. Kennedy Financial Services and Smart Money Group LLC are separate entities and are not owned or controlled by Calton & Associates Incorporated.